You got a hold on Marriott. You got the price target at 226. That kind of implies like a 9% downside move. What moves this stock lower? I mean, Marriott has just such a wide range of brands for different price points. Where do you see the pressure on this business?
Look, I think what we've seen so far from the other large hotel companies, and I expect we'll see something similar today, is a pullback in RevPAR, which means occupancy and pricing. But what is really driving these stocks is actually growth in their system. So all of these large companies have told us really a mixed bag of outlooks. They've beaten their first quarter and pulled in their guidance for the remainder of the year on some said large corporate was strong. Some said smaller corporate was strong. Some said, group was stronger than others. Some said government slowdown, some not. So we've really had just a mixed bag of data points. And I think that aspect of it, in terms of what the guidance for the rest of the year for Marriott will be quite interesting. The one thing that's common is that that net unit growth, which is the driver of the valuations on these stocks, has been consistently held. And we expect Marriott, who's going to grow their system 4 to 5% this year, we expect them to hold theirs as well.
All right, so David, a lot of earnings when it comes to the hospitality space, the travel space, also the restaurant space, a number of names across the board. Another one is Wynn that you seem to be a bit more positive about. So is gambling just more protected from some of this consumer slowdown? Also, how do you see Disney? Obviously, a big theme park business. Kind of give us a sense. Is Marriott and what we've seen from these other hotels, is it a read into any of the other earnings that we're expecting this week?
Yeah, I think it is in part. When we look at what drives Marriott, it's going to be two things. It is going to be, to some degree, RevPAR. What are people paying for rates, how much occupancy, and how much demand? And as I said, there's been a very mixed bag. When we look at what ultimately drives hotel companies, those that are really focused on them, it's net unit growth. It's what's driving their fees. Because what comes out of that unit growth are ancillary fees or co-branded credit card fees or other royalties that they're earning. And those fees are growing faster than the consumer-driven direct core business. And that's an important aspect that those other companies don't really have that you mentioned.
Okay. I asked you about gambling. You didn't quite answer that one, but there's some other gambling results coming up. There's Penn, there's also DraftKings. So I just want to ask you, I mean, when we're talking about consumer discretionary spending on leisure activities, is gambling protected from some of this slowdown, or is it also just subject to the consumer going, I might want to pull back?
Yeah, to answer your question very directly, Frank, what we have seen historically is that domestic gaming, particularly regional gaming, as you mentioned, Penn, Wynn plays there just a little bit, has been a very stable plus or minus 5% top line business for many years, even through the GFC. I recall writing those notes where, Vegas may have struggled, other areas of hospitality struggled, but regional gaming tends to be very stable. And as for Vegas, since you did point out Wynn, we are still seeing very strong demand. We've already heard from MGM and Caesars that Las Vegas has sustained itself quite well because it is the preeminent group destination and event destination in the country, if not the world. So very stable there. Mixed bag across all of our coverage.